Happy Thursday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Thursday, February 22nd, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro event is our green shoots globally theme persists. So the nuance there is the first batch of preliminary February PMI data from around the world indicate our green shoots globally theme persists. Of the 7 major economies that have reported thus far, only 2, Japan and Germany, saw their composite PMIs tick down month over month. Each of the 11 major economies we keep growth, inflation, and policy tabs on daily via our global liquidity monitor feature a composite PMI that is trending higher. Elsewhere, NVIDIA results last night gave investors confidence that the AI bubble has legs. Duh. We are in a risk-on reflation market regime that is getting incrementally stronger by the day, as evidenced by today's bearish VAMS breakdown in the dollar, US dollar index, and the bullish VAMS breakout in the 10-year nominal treasury yield. In terms of market implications, per our fundamental research summary, which is derived from our 125-slide monthly macro scattering report presentations, we currently expect to remain in a risk-on market regime until around mid-year. The market regime pivot from Goldilocks to reflation this week confirms the probability of a soft landing has peaked and that the probability of a no landing is appreciating on a relative basis. Again, we currently expect the rising probability of a no landing will carry the reflation regime until around mid-year because we anticipate the Fed and/or Treasury Department will be forced to respond to likely positive surprises in nominal GDP with a less favorable policy mix, which may include pivoting back to higher for longer forward guidance, which may inflate the reverse repo facility balance, boosting the TGA balance and/or net bond financing. That, along with a potential trend inflection and global liquidity, may usher in a risk-off inflation market regime by then. So again, that's our current view based on our current combination of quantitative risk management signals and our fundamental research summary. Obviously, we execute our Bayesian independent fundamental and quantitative processes on a daily basis 6 times a week here for our clients at 42 Macro. So that may change, but that's what we're currently thinking today. So transitioning to our 42 Macro dashboard here. As always, we'll start with our trading range signals from our friends over at Longbow, getting some overbought signals here this morning in equities. Overbought signal here in the S&P 500 there, getting an overbought signal here in the NASDAQ 100 as well. Not quite overbought in the Russell 2000, so not participating as much. Shanghai Composite also overbought this morning as well. And I believe that was it in terms of actionable signals for today. Again, these are tactical short-term signals for those of you who are higher frequency traders or more slower-term traders that are looking to enter or exit trades, more medium-term trades. So better time those entries and sales. Transitioning to wrapping up with a question from our community here. Says, hey, Darius, what do you mean by first, second, and third turning regime? And then also, how do you measure or calculate U.S. liquidity? So I addressed those separately. So I assume that this client is referencing our fourth turning analysis. We did a deep dive empirical study on what investors should expect in this fourth turning regime, which my former colleague and one of my mentors, Neil Howe, believes is likely to persist for the next 10, 12 years or so. And so we did a deep dive empirical study on what's likely to happen with respect to the economy, what's likely to happen with respect to policy, and ultimately what's likely to happen with respect to asset markets, with data going all the way back to the 1800s for a variety of key statistics at tracking those key components. So just so a little bit of background in terms of the fourth turning. Obviously, Neil Howe, this is his seminal work. He authored this thesis with his late colleague Bill Strauss back in the early 90s, and really it's kind of in summary, it's a historical sort of overview of how the U.S. and really Anglo-Saxon across the Atlantic political cycles have evolved over time and really have become very cyclical and produce very specific kind of geopolitical outcomes and political economy outcomes within society. And the fourth turning is the one where all hell tends to break loose, and you tend to see a destruction of legacy institutions, whether they be government institutions or general ways of operating from a business and or a societal standpoint. Thinking like the breakdown of slavery or the ushering in of civil rights, things like that. So in terms of in terms of the fourth turning regime, obviously Neil's work is more focused on geopolitics and the political economy cycle of that. What we've done here at 42 Macro is actually focus it on the metrics that you need to care about, and that you should be caring about as an investor. So if you have not checked out that research, highly recommend. In my opinion, that's some of the best research I've ever performed in my career, and I'm a damn good research analyst. Ask your favorite buy-side PM, CIO, or analyst. And lastly, wrapping up, how do you measure or calculate U.S. liquidity? The way we calculate U.S. liquidity is the way that everyone now calculates U.S. liquidity because of us, thanks to our friends over at Morgan Stanley. So we built the 42 macro net liquidity model a couple of years ago to help understand the kind of all the moving parts within the U.S. liquidity, within the Fed and Treasuries, combined policy mix that really have a dominant influence on asset markets, and that is the total assets on the Fed's balance sheet minus the reverse repo facility balance minus the TGA balance. Those two things, when they're rising, drain liquidity from the system, and when they're falling, they add to liquidity from the system. So again, that's our metric. I don't care anymore that everyone is using it and retweeting it. Again, thanks to our friends over at Morgan Stanley about a year ago or so, but that is what it is. So there's other ways to think about liquidity. That's not the only way to think about liquidity. Actually, if you look at our macro weather model, in terms of the excess return dispersion backtest in that macro weather model, global liquidity is actually a better, sort of a more powerful force upon global asset markets in terms of how we calculate global liquidity here at 42 Macro. That's the global central bank aggregated central bank balance sheets from all the major economies in the world, the aggregated broad money supply from all the major economies in the world, and the aggregated global FX reserves minus gold for all the major economies in the world. Each of those things contribute to rising and falling liquidity that may impact asset markets and improve or reduce the supply and demand for asset markets. And so, liquidity that's another way to calculate liquidity. We also think about liquidity from the perspective of things like treasury, auctions, net financing. Those kinds of dynamics can have a pretty meaningful impact on asset markets, certainly as we've learned from the Q4 and Q1 quarterly refunding announcements. So we'll wrap it up there. Darius Dale presenting our macro minute for Thursday, February 22nd, 2024. Everyone have a wonderful day out there. Best of luck. We'll catch you back here tomorrow. Cheers.